This is an analysis from Alpha Business Media.
Right now, something huge is happening, deep inside the plumbing of the world's financial system, but you probably haven't heard much about it. See, it's not a loud, dramatic crash. It's quieter, more deliberate. We're talking about one of the biggest strategic shifts of money we've seen in a generation. So let's get right into it.
All right, here's our game plan for this analysis. We're going to break down what we're calling the Great Rotation. First, we'll look at how this all got started. Then, we'll dig into why so much money is cashing out of Silicon Valley. After that, we'll follow the trail to see where it's landing, specifically Asia's new factory floor. And that's going to lead us to a fascinating case study, Nepal, a country that's really at a crossroads right now. And finally, we'll wrap it all up with our final verdict.
So what exactly is this Great Rotation? Well, in simple terms, it's a massive, coordinated retreat of money from the big U.S. tech sector. But, and this is key, this capital isn't just going into hiding on the sidelines. No, it's on a very specific, very calculated journey. And that journey is headed east.
Okay, and this is probably the most important thing to get straight right away. This is not a panicked sell-off. It's not 2008 all over again. The data shows this massive, torrential outflow of cash, but it's orderly. Think about it less like a chaotic fire drill and more like a planned, strategic evacuation. The destinations are already on the map. This is smart money moving with a clear purpose.
So the big question is, why now? For more than a decade, the mantra in finance was simple, right? Just buy U.S. tech. But that playbook, it's been torn up. That whole consensus has completely shattered, and it all boils down to one sober realization. The prices, the valuations, have just gotten way ahead of any realistic possibility of future growth.
And to really wrap our heads around this, we have to look at a classic fundamental metric. It's called the price-to-earnings ratio, or PE ratio. It's actually a pretty simple way to figure out how expensive a stock is. Basically, it tells you how much you're paying for every single dollar of a company's profit. Or think of it this way. It's how many years it would take for the company's current profits to pay you back for the price of your share.
And when you look at the data, the difference is just staggering. Look at this. Back in late 2025, you had U.S. tech giants trading at PE ratios of 70, sometimes even 100. That's like paying for a century's worth of profits up front, assuming everything goes perfectly. Now compare that to a solid Asian industrial company trading at a PE of, say, 14. The entire risk-reward calculation has been turned on its head. It's not that investors are giving up on American innovation, they're cashing out of American overvaluation.
And look, it's not just about the numbers, the math. There are some serious headwinds blowing against big tech now. You've got this constant regulatory pressure, antitrust lawsuits coming from both the US and Europe. That puts a very real ceiling on how much bigger these companies can get. And that golden era of just easy, frictionless global expansion that built these empires, yeah, that world is gone.
Okay, so the PE ratios tell us pretty clearly why all this capital is packing its bags. The next logical question is, where exactly is it going? Well, the data points to one specific destination, what we're calling Asia's new factory floor.
And the key indicator we're looking at here is something called the PMI, the Purchasing Managers Index. The easiest way to think about it is like taking the pulse of a country's manufacturing economy. It's a real-time survey of the people actually buying the stuff to build things. And the rule is simple. If the number is over 50, the factory floor is growing. If it's under 50, it's shrinking.
And this chart just lays the story out perfectly. You see the US and Europe just kind of treading water, right around that 50 mark, stagnating. But then you look at India and Vietnam. They are absolutely surging. We're talking 58.2 and 57.5. And you have to understand, these are not just abstract numbers on a screen. This is the sound of an industrial engine roaring to life. This is factory managers saying, we've got a flood of new orders, we're hiring more people, we're cranking up production. It's real.
So what's fueling this boom? It's a direct result of a massive shift in corporate strategy. After the pandemic, after all the trade wars, companies realized just how risky it was to have all their supply chains tied up in one single country. So they started to de-risk. The old idea of China plus one has evolved. Now it's China plus many. And the biggest winners of that shift, the prime beneficiaries, India and Vietnam. That's why you're seeing giants like Apple and Samsung pouring investment into those countries.
Now, this huge global realignment is a golden opportunity for any emerging economy, right? But to really understand the challenges of grabbing that opportunity, let's look at Nepal as a case study. Geographically, it's in a perfect spot.
And yet, while all this money is redrawing the global supply chain map, Nepal is, well, it's basically invisible. And that brings up a really critical question that applies to a lot of countries.
The numbers for India and Vietnam look fantastic for sure. But what's the real driver? What's the one thing that ultimately convinces someone to move trillions of dollars from one country to another? I can tell you it's not just about cheap labor, and it's not just about how big the market is. It's something much more important and a whole lot harder to build.
It all comes down to one thing: policy credibility. You have to remember, global capital is, at its heart, cowardly. It despises uncertainty more than anything else. An investor who's about to sink $1 billion into a factory needs to trust that the rules of the game aren't going to get changed on a whim 5 years into a 10-year project. We're talking taxes, regulations, ownership rules, the whole thing. And that's what India and Vietnam have done. Over decades, they've built up that trust by being relatively consistent and pro-investment.
And when you mix that trust factor with the hard numbers, the picture just gets crystal clear. Take a look at this table. It uses something called the PEG ratio. All that is the PE ratio divided by the company's expected growth rate. And the rule of thumb is anything under 1 is considered a great value. So you see the US tech stock? Even with good growth, its PEG is way up at 2.8. It's expensive. But the Indian and Vietnamese companies, they're offering really strong growth at an amazing value, with PEGs way below 1. This, right here, is the simple math behind the great rotation.
So this all leads to a really stark choice. And this isn't just for Nepal, it's for any country that wants a piece of this action. You have two paths. The bull case is taking radical, immediate action. It's building that stable policy environment and grabbing your piece of the pie. And then there's the bear case, which is just inertia. Doing nothing and watching from the sidelines as these new global supply chains get built somewhere else. It means squandering what is truly a once-in-a-generation opportunity.
And that brings us to our final verdict. Look, this great rotation isn't just some passing trend. This is the defining economic story for the rest of this decade. And the lessons we can draw from a country like Nepal apply everywhere. How a nation chooses to act in the next, say, 24 months could very well decide its economic fate for the next 24 years.
And here's the hard truth that this whole analysis points to. It's a truth that you see in so many developing nations. The biggest competitor isn't the country next door. It's your own internal paralysis. It's bureaucracy, it's inertia. Because at the end of the day, global capital is ruthlessly meritocratic. It doesn't care about borders or politics. It will always flow to where it's treated best, where the risk is lowest, and where the story of growth is the most believable.
So, let's wrap this up. The trillions of dollars are already on the move. That's a fact. And that money doesn't owe anyone an investment. So the only question left for Nepal and for every other country watching this unfold is a simple one. Are you going to build the landing strips for this capital, or are you just going to stand there and watch it all fly right over your head?